All right. Welcome to Be the Market Expert. And let's kick it off here. Let's start right here as we're looking at things. And this came from Resi Club, and it reads this: Morgan Stanley argues that U.S. homeowners are the strong hands this cycle. Okay, cool. So then we look through, and everyone's like, "What in the world is strong hand?" Even Elizabeth just looked over here, thinking like, "Is that English?" And it says that the strong hands refers to investors or market participants, homeowners, participants who have financial capacity and confidence to hold on to their assets for a long period, even during periods of market volatility or downturn. Now, here's the thing: I don't think we have a volatile market whatsoever. Yeah, real estate isn't a recession. Like, there's no debating that. When we're looking at this thing, we're talking about what's happening in the real estate market. We are the gatekeepers, the conduit for the largest financial purchase that most Americans make in their lifetimes, right? Especially in Colorado. We're talking about an average price point of $600,000. And with those dollar amounts, we are unproportionately impacted when rates go up, right? When we're talking at 7% interest rates, and people are looking at a price point of $4,000 per month to purchase a house, like, obviously real estate is impacted first and foremost. And when interest rates start to go down, and we're going to look at a web page here soon that's showing that they're going down, that we know that we are going to see more people raise their hand excited to purchase again, right? This isn't a thing where people are backing away from buying real estate because they don't believe in it. It is an affordability issue. And I would argue this as well. Like, as we're having these conversations, most people could afford it. Like, most Americans could afford to go out and buy a house right now. It's just that back in 2021, we're all living back when interest rates were at 3%. And that's where people are wishing that these numbers get back to. And I don't think there's a world where that happens. But check this out. So looking a little bit further in this graph, this is mortgage-free homeownership. All right. So the point with this and with what we're looking at right now is all of the news headlines that are continuously reading the crash, the bust, the bubble, the silver tsunami, the insert whatever here, it's all garbage. And as we look at this thing, mortgage-free homeowners, and this is going to 2022, I would say that right now we're probably closer to 48, 50%. But back in 2022, 38.5% of all owner-occupied units did not have a mortgage. Be thinking about that. We're closer to half of the population right now, owner-occupied, does not have a mortgage. So when we're going back and we're talking about 2008 and all these other things, and the people want to connect these dots and put these lines that do not exist, how can we say that we're going towards an environment where we're going to see foreclosures and short sales and all these other things happening when almost half of Americans in the United States don't have a mortgage on their house, because that is the best home ownership that we've ever had if we were to look at the balance sheets. So it says among US homeowners who have a mortgage, 96% have a fixed rate mortgage. All right. So when we're talking about a 30-year, right, that's what we think about in the United States. I'm going to show you guys a graph here next, which is very interesting. And then I actually pulled up another slide because I had some interest after that. So it says measured aim at curbing risky lending practice among around 80% of US prime mortgages issued prior to 2008 bubble burst were ARMs. Okay, cool. Here's another data point, guys. So as we're having conversations and people are talking to you and they're like, well, you know what? I'm waiting for the crash like back in 2008. Well, if we were to look at the bubble burst in 2008, we can actually draw a line saying, well, did you know that those mortgage products that they had back then were ARMs, which means that their interest rate fluctuated with what was happening in the economy. More people in the United States, I'm going to show you this here in a second, have a fixed rate to where they're locked in at some of the lowest interest rates we have ever had as a nation. So check this out. Mortgage market composition by country. All right, this is what's interesting. So when we're talking about mortgage products. I need everyone to be well aware, and we're going to look at France here in a second, because that's the interesting one. That's the outlier. Do you know how blessed we are? And I'm not like one of those guys that has the sign in my house that's talking about blessed and everything, but this is very real. Look at this: Finland, Australia, Ireland, Sweden, Italy, the UK, Canada, Germany. Look at their loan products. 95% of all mortgage products in Finland are a variable rate, which means that whatever's happening in their economy, that's what happens to their mortgage as well. Rates are going up, their mortgages are going up. Rates are going down, their mortgages are going down. Australia, Ireland, Sweden, right? Sweden gets at least a 50%, but they have short-term fixed, which is interesting, which means from year 1 to year 5, somewhere in that period, they are set at a fixed rate, and then it changes after that 5 years. Then they go with what the market's doing. We look at Italy, their shorter time, the UK. Guys, our loan product that we have in the United States at a 30-year fixed is one of the best products that is out there. And we're one of the only countries to have this. So when you're talking about the overall health of the U.S. consumer as far as purchasing real estate, we are in one of the best positions possible. And so I did see France, and I was like, really, does France really have a product that looks very similar to ours? Because, guys, this is the thing. Most countries do not. And here's the graph right here. Most countries, while you can go get a 1 year to 5 year where it's fixed, then it gets weird. So I looked it up. That was the path that I went on today. I was like, really? Like, you can go and actually go get a product that resembles ours in the United States? And the answer is no. So take a look at this. So when I was looking at this and I dove into a little bit more, I said fixed rate mortgages in France. Fixed rate mortgages are the most common type of home loan in France. Okay, so fixed rate. But they're usually from a 6 to 25 year cycle, with 20 years being most common. Okay, so yes, they are on a fixed percentage, which looks very similar to ours when I looked at the percentages, but they're on a 20-year versus a 30-year. And it went in to say that your typical down payment is around 30%. So they are bringing 30% down, and they are on a 20-year product. Where ours, right, we know that we can go as little as 3 to 6% down. In some cases, CHFA, when we're talking about different loan products in Colorado specifically, we've even seen home buyers get money back. Yes, the interest rates go up, and it's over 30 years. And there's talks right now about 40-year products and different things. So very interesting as we look at this, guys. And then we're not going to look at the interest rates of outstanding, but I do want to look at this graph. Interest rates on outstanding mortgages. And here's a pie graph, a pie chart. And this is 76% of US mortgage borrowers have an interest rate under 5% according to the FHFA. So, right, we're talking about the Federal Housing Finance Agency, and this is out of the mortgages specifically. We can look at this, and here is all the population that has under 5% interest rates. Here's 50 of it right here is 4% and lower. So as we're thinking about this, and we're thinking about all these people that have these low interest rates, where in the world are we going to see people start to default on these, and where we're going to see anything resemble 2008? There is nothing in the data lines that are showing this. Now, we also have to keep in mind here, a couple weeks back, while we did look at some of these people that are underwater, right? And it's a very, very small percentage across the United States where people are actually upside down on their loans. The only reason why that would be getting into an area where there's an issue is if the bank calls it due and they lose their job. Right? Like, they would have to lose their job and actually not be able to pay their mortgage, because this is the thing. Banks are not real estate agents. They do not want the inventory. There's no world where, these banks go out and they want to actually have their for sale signs out in the yard and be selling these houses. They don't want 2008. They're doing things to work with people because they rather do what they do best, and that's loan money and collect money back. They don't want to be in the process of selling houses. So as we're looking at this thing and we're seeing that this is where 76% of mortgage borrowers have an interest rate that's under 5%, that tells you that a lot of people are in a good position. So very interesting stuff as we're looking at this thing. And again, like the biggest piece is that most people in the United States, more than 50% at this point, we're close to 50% don't have a mortgage. And the people with a mortgage, the other half the population, their interest rates are below 5%. 76% of that 50% have an interest rate under 5%, which is interesting data. Now, here's something that just came out. This is the second or third time that I've seen this across different platforms. I saw this on Twitter earlier, and then I saw it on Housing Wire. Biden to propose a national rent hike cap of 5%. Now, this is where this thing gets interesting, because I want you guys to think about this. And we're not going to turn this into a political statement and take it for what you want. So we're just going to say the United States. We're going to say the president of the United States. Let's take red, let's take blue out of this. The president of the United States has come out and said that they are proposing a national rent hike cap of 5%. Now, with that being said, yes, this is something that they are going to be running on for the next election cycle. Like, this is one of their promises that they're running on. And this is where it gets weird. And this is what I want you guys to think about. When we're looking at a 5% rent hike cap, what does that do? And when we look at it a little bit further, it says, well, if you're an institutional landlord, then that means that you are automatically enrolled into this. So anyone that has, more than 50 rental units, they have to follow this process. The other half of these investors are saying that you're going to lose out on some incentives if you don't follow this product. So as of right now, it looks like it might be optional. And so we'll have to look, because again, this has just got said the other day. So it could be optional. Unless you are an institutional investor, then it's mandatory. And if you do opt in as a non-institutional investor, then you get some kind of tax incentives that you would otherwise lose if you don't opt in. I don't know what that is. I don't have any of that information. But this is what I want you to think about. So if we're going through and we're saying, hey, institutional investors, you're being capped at 5%, and we're going to tell you with what you can do with your investment money, you're capped at 5%. Well, this is where it gets interesting. So right now we have some of the highest interest rates that we've had in recent history. Okay, not the highest ever, but in recent history. So cost of materials, cost of labor is up, and interest rates, the cost of money is up. So we have both those things playing against us right now. Why would someone that is going to go and purchase a property like this, or maybe like just think in Colorado, where we don't see a lot of condos because of legislation that's around it, that why would someone actually go invest this kind of money, millions of dollars, in some of these units, to then be told how much money they're allowed to make on their money and to cap it? It doesn't make sense. And so if this does get passed, this is what I want you guys to think about. We're probably going to see more inventory constraints, okay? Because if the cost of money is expensive, the cost of labor is expensive, the cost of material is expensive. And so to be able to go build these expensive projects are expensive. And we're being told at this point that if you do go out and invest this money and put this kind of workforce to work and to deploy your capital into these different areas, then we're also going to limit the amount of money that you're allowed to make on your return every year. So I do think there's going to be more inventory constraints as this kind of unfolds, which is super unfortunate. So as we're looking at this thing, this will be very interesting, because I think a lot of people are celebrating this, just like they celebrated what happened with the commission lawsuit, right? They were like, it's going to be cheaper for Americans to go buy houses now, and there's no proof of that. Same thing here. They're going to say, we are going to help the everyday average Joe be able to go afford their monthly rent. But I don't think that's the case, because this rent hike is really just going to be for people that are actually in their building. So if you actually leave, then they can raise the rates whatever they need to. And when there's less and less housing, because less houses are being built, we've looked at that, permits are down. Permits are down, so there's less homes being built. And now we're saying that they have to cap where they are as far as raising rates. They're going to be building less and less houses because there's not enough money, which means they're going to take that capital that they would have done building more homes for people, more rentals for people, and instead they're going to deploy that capital where they can make more than 5%. And guys, those places exist. They can make more money than what they could in real estate at this point. And so this is a very interesting thing to be looking at. We're going to see how this plays out. And again, this is a campaign promise. So if, depending on how the election cycle goes, this may or may not come to fruition. So, but this was very interesting to come out the other day, that this is something that says, if I get elected, then this is something that I will bring to fruition. And so we'll just have to keep our eyes on it. Now, here's where we're looking at some national data, right? Mortgage rates head lower, helped by better mortgage spreads. So when we're looking at this thing, this is Logan Mohtashami. This is the lead analyst for Housing Wire. And again, we're looking at national data. So in 2023, following the collapse of Silicon Valley Bank, right? We all saw that they defaulted, they didn't have enough money. And just picture this, right? This is what this looks like. When they default and we have this collapse, what happened was literally people were going to the bank, they were knocking on the door and they said, I want all of my money. And then the bank was like, we don't have it. They're like, what do you mean you don't have my bank? I got a receipt right here. It reads that you have all my money. I want it. And they didn't have it. So then the government had to bail them out. And this is what was happening. So it says the spreads between the 30-year mortgage and the 10-year yield were at its worst, leading to the new cycle highs. And the most recent mortgage rates were significantly higher than the average. However, this year we're seeing a different trend with spreads, and they're improving, and mortgage rates are trending better as a result. Okay, so we're not going to play with mortgage spreads. We're not going to talk about the 10-year yield. We're not going to talk about any of this. But what we should be talking about is purchase application data. The last time we saw 12 weeks of positive trending purchase application growth was when mortgage rates reached 6%. And they have positive for 4 of the last 5 weeks, and mortgage rates aren't even near 6%. So what this is saying is this: when rates were at 6%, we were seeing positive prints, people raising their hand. Mortgage purchase application data means that your clients are raising their hands and saying, Mr. and Mrs. Lender, I am looking to see how much I qualify for. This is what this data is. And so with interest rates where they are today, and we will look at this, we're actually seeing more people get interested in purchasing a house. This is good news. This is very good news, everyone, because what we're seeing is interest rates are starting to go down. They're ticking down. We're seeing everything that's happening that needs to be happening. And keep in mind, this is what it looks like. We're dealing with two different things. And unfortunately, one has more weight than the other one when we're talking about our Fed. And so right now we have inflation. Inflation is going down. Inflation's going down. It's on track. If anyone was on the call with Ruben Gonzalez yesterday, which is our chief economist for KW, who's on our on our Colorado call, we looked at inflation data. We're on track. We're going down. It's looking good, which is super exciting. We're on track for what the Fed's looking for. But right now, the other thing that's keeping interest rates kind of where they are, but they are trickling down, is employment. And what we're seeing with a lot of things, and keep in mind, the biggest thing that we have, whether we're not exporting or importing, is real estate, right? We have Americans building houses. And so that's our biggest thing. But at the same time, we're talking about purchase application data going up, but building permits are going down. All right, so building permits are going down, which means that these projects are coming to an end. As these projects are coming to an end, we're going to see this labor force start to trickle down. And as one of the biggest labor forces that we have is inside of real estate, that we're going to actually see more people lose their jobs, which in turn interest rates will start to come down more and more. So we beat the inflation piece. The inflation piece is getting back on track. Now we're looking at job applications and job data, which is starting to go down. So purchase applications, we're seeing go up, which is exciting. And here we are. So here's 2022, and we see we were really high, right? Interest rates were still pretty low in this area. And then we started seeing rates going up. And this is 2022. Remember, we saw it go up quick. It was the fastest. It was the fastest we ever saw interest rates go up in our history, right? They went up very quickly over a very short amount of period of time. Everyone was shocked. They started putting on the brakes, and we can see the purchase applications started going down. I mean, it went down pretty significant. And then in 2023, we lived with pretty high interest rates, right? Interest rates were very high. And like, we weren't seeing too many people excited about buying houses. These were the motivated at this point. These people were motivated buyers. And then here's 2024, where there's just been some instability and there's been a lot of talk around interest rates going down, interest rates going down. And then every time the Fed meets, they're like, we're not doing it. We're not doing it. And right, they said we're going to go from 6, and now we're down to like maybe 1. Like we're hopeful that we're going to have 1 rate cut. And so we're looking at this, but this is where it gets interesting, is that we're seeing positive prints, right? Here we are. Here's the basement though. So we're just pretty much in the basement as far as it goes with purchase application data, but 4 out of 5 good positive prints is a solid, is what we're seeing. So this is my question, everyone. Is this your client? Did your client reach out to a lender and ask them what they qualify for? And do you know? And here's the thing, guys, if we're not in a relationship, who's going to be in that relationship with them? Does that lender have another relationship with a real estate agent? They're like, hey, you know what? I'm super glad that you reached out to me today. And this is what you qualify for. And here's my preferred real estate agent. And do you think that they're mentioning you? And so we're seeing 4 of these positive prints happening, which means that people are getting out there. People are starting to get motivated. People are finally accepting that interest rates aren't going to be at 2% anymore. The media let them down. They were talking about the housing crash, the Airbnb bubble, the silver tsunami. They're talking about all this stuff on why home prices were going to go down, and it did not happen, and it's not going to happen. There's no world where it happens. And so now people are tired of waiting on the sideline. They're motivated. They have things that are happening in their life that is making them want and need to go buy a house. Are any of them your clients in your sphere of influence? And do you know who they are? And guys, I would start my campaign, start reaching out, start taking massive mind share now, and making sure that you are that real estate economist of choice, and making sure that you are educating and that you are doing your due diligence to get your unfair share. So then we're looking at weekly housing inventory data. And so here we are, this is last week, right? We're looking at rear view facing data, and it's went down a little bit, right? It fell. We fell 1,000 homes, right? 1,000 homes went down. This time last year, there was an increase, but you can actually see that we're like 200,000 homes different. So we're getting more and more inventory on the market. Our all-time low back was in 2022 with 240,000 homes. And if we were to look at just the yearly inventory peak for this year, 652, 573. Okay, cool. So the number that we're tracking against was 2 weeks ago was our highest all time, and then we fell a little bit. So that's kind of good news as we're seeing this, is that we're not having some real giant slip. We slipped 1,000 homes of active inventory. And then again, if we're talking about 2015, and again, everything that we look at, guys, we want to base everything off of 2019 data, pre-pandemic. So we don't 2020, 2021, 2022, 2023, even 2024, weird stuff, right? We got to keep in mind, 2020, we had COVID, right? The world was shut down. There was times where there was a time where we woke up one day and we didn't even know if we were allowed to be going outside. All right. That was 2020. 2021, the lowest interest rates we've ever had. Money was free. 2022, still kind of low. Then the interest rate spiked up very quickly. 2023, the interest rates were as high as they've ever been in modern history. 2024, we've seen a little bit of fluctuation, but they've been fairly high. a lot lower than 2023, but still high. So we don't base anything off of these last years. We base everything off of 2019 because that's what we consider a normal market. So 2019 back in most recent years. Now, if we're looking at this thing, national home inventory, here we are. Here we are. So 2024, we're in July. We're going up against 2020 data. Okay, cool. So the world opened back up. We realized that the world was not ending, which was exciting for a lot of people. And here we are. So 2021, 2020, 2022, 2023. Here's 2024. We're almost above, slightly above 2020 data. This is what we're aiming for. We need 2018, 2017, 2019. This gets us into a more normal market where there's better and less competition, to where there's more choices for our buyers to go out, and we're not in this savagely unhealthy market that we were in 2021. But we need to keep this in mind. Like, as we're going through and we're looking at these new listings and we're looking at this total inventory, we need to be very well aware of this. If interest rates do go down to about 6%, which they very well could, it's not going to happen overnight, but 6% is very, very real in the near future. It's going to be a frenzy, everyone. 6% interest rates wakes a lot of people back up. And so that's kind of the magic number that we're looking at. We're not waiting for 3%. 3% will never happen again. It will never happen again. So we can't be looking for 3%. 6% is probably going to be the number that we're going to live with for a very long time as far as interest rates. We might see it kind of start going back down to 4.5%, 5% at some point. 6% is going to be very real. 6% is going to get a lot of your buyers back off the couch and looking at houses. And so we need to be very prepared for that. And as we're looking through, the biggest thing is this inventory. If there's not inventory coming on, you can actually see this as new listings, national single family new listings. You can see that we went down a little bit here, right? Week over week, we went down to new homes coming to the market. So as we're seeing less permits for new houses being built, we're seeing less permits for apartments being built. We're seeing that even if these people did want to go out and build an apartment building, we're going to cap them at their investment. There's a whole lot of things pointing to there's not new inventory coming to the market. So it's going to be the resale market. The resale market is going to be what's driving real estate, which it has for many, many years, right? The resale market has been king. Now, 2023, 2024, it has been more than new builds because they've been able to buy interest rates down and they've taken a little bit more market share. If we're looking at this, though, we just need to be very well aware that interest rates start going down. There's no homes. We're going to see people overbuilding for houses again. They're going to be offering X amount over. They're going to be waiving contingencies. It won't look like 2021 per se, but we will start seeing more and more people raise their hand. Price cut percentages. We know this: 1/3 of all homes in the United States take a price cut every year. So we average 33%. Nationally speaking, we're at 33 or 38%. We'll look at Arvada here soon. Arvada is way higher than this. So we're way higher in Arvada right now for price cuts, but nationally speaking, 38%. So we're pretty much in line. Here it is right here. We can see 2022. This was a big swing, right? This is where interest rates started getting really crazy really quickly, and the people were motivated. They needed to sell their house. So they started dropping prices. And here's 2023 data. And again, it's this seasonality, right? We can see this. This is the summer months. This is where real estate starts to slow down. So we actually find out who truly is motivated, who is truly looking to sell their house. Pending sales data, right? We do want to see pending sales go up. It's dropping a little bit, which we can expect that because there's not a lot of houses for sale. Here we are again. We're right in line with 2023. And so 2023, not the greatest numbers, but that's where we are. And so week ahead, so this is this week. Again, remember, we're looking at rear view facing data. So Powell will speak again on Monday, and a few Fed presidents will speak. So this was yesterday that they spoke. And we'll look at what happened. It says retail sales are on Tuesday. And so we'll hear about that. And so we need retail sales. That's one of the biggest numbers. And so when we're talking about inflation data, yes, inflation data is important. But one of the biggest things that's happening is, well, what's happening today. So if anyone as a normal American, you probably got some emails leading up to today. Can anyone tell me, throw it in the chat or come off mute? Does anyone know what today is? It is June 16th. Or July 16th? What's happening today?
Amazon Prime.
It's Amazon Prime Day. Yes, it is. It's Amazon Prime Day, which is a big deal. Amazon is going to be making a lot of money today, which means there's going to be a lot of credit cards that are going to have more money put to the negative on them. And this is one of the things when we're talking about inflation data, it's actually that. Well, they don't really look at, I mean, yes, they look at housing, but housing's so skewed that these are actually the numbers that they are really looking at is how much money are the Americans going out and spending on stuff that they do not need? Like, that's very important. Like, that's like they're looking at these numbers. So as this stuff's happening, I would say if they're looking at data next month, which they will, and how much money went into Amazon and how much more our credit card debt and everything has gone up, interest rates are going to be a little shaky this time next month. And so we'll look at it. So single family permits keep falling. And again, when we're talking about new builds, they're not charity. They want to make as much money as possible. Interest rates are so high right now. People aren't buying as many houses. They don't want to be cutting prices. So they're going to slow their inventory down, which is going to keep their prices elevated. Now let's look at interest rates. So Amazon Prime Day, everyone don't go rush out and go buy stuff because you're hurting the economy. But if we look at this thing, here's just 1 month's worth of data. And you can see, guys, we're trickling down. We're trickling down right here. Like, this is going down. And so 6%, while it's not going to happen overnight, it's very, very real. And I'm telling you, it's going to be gangbusters. 6% hits, you're going to have people get off the fence. I promise you, 6%. People are going to be rushing to buying houses again. It's not going to be 2021, but you're going to see a lot of people get comfortable with that number. Here's what's interesting, like this big spike that we had right here. If you were to go back on the June 27th, Kim knew the last answer. Kim, what happened on June 27th?
I don't remember.
June 27th was the debate. So the debate happened, and there was a lot of questions of who's going to be the next president, right? And so this right here is what actually sent interest rates going higher. They were like, there was a lot of people that were thinking that we're going to have a change in leadership. And this is why interest rates started going up, as people were moving a lot of money around and a lot of things were happening. So rates started going up, and you can see this. And so now they've actually started coming back down now that everyone's kind of feeling a little bit better again, and some things have happened. So again, while I do think we're going to see a little bit of a blip next month because Prime Day is going to host a lot of stuff, it really is. We're going through, this is good stuff, and it's 6%, guys. Be prepared. I'm telling you, you're going to be busy again. 6% hits. Then we look at this. Let's talk about Arvada. And so the brokerage is in Arvada, so that's why I like to talk about Arvada. And here we are, median list price. So again, when we're talking about median list price, we have to keep in mind this. We're taking the lowest price house, we're taking the highest price house, and we're just chunking it down. We're getting to the middle. This is the middle number. In Arvada, the list price is $737,000, which is pretty flat. What's interesting, though, is homes that are hitting the market, it's actually gone up. It's at $785,000. So new homes coming to the market right now in Arvada, the median is $785,000, which took a little bit of a spike of the tune of $85,000. So I don't know what has caused this. I would have to look at it, but obviously we're either not putting as many condos for sale and smaller houses, and it's, you know, it's higher price point houses, maybe in West Arvada they're popping up, and they are doing some stuff over there. So I would have to look at this a little bit deeper to see how we have an $85,000 swing over 1 week. But price per square foot has also gone down. So something weird is going on here. So I'd have to look, which also makes me think it's higher price point homes that are really hitting the market. Average days on market is going up, and we've seen this. So average days on market is going up. Median days on market is going up. But this is the big conversation that we're having. If we're sitting at the dining room table with someone, this is why pricing matters. The average price point home, right? We're taking all the numbers, we're dividing them by each other, and we get the average. These are people that aren't pricing their house right. 51 days on the market, almost 2 months. And if we're talking about people that actually price their house right, while it has gone up a little bit, 7 days, almost 1 week, it's 28 days. It's still 1 month on market. So these are the conversations that we need to be having with our sellers. When they're talking about pricing, we got to be looking at the competition. And the competition is active homes on the market. All right, in the neighborhood. That's your competition right now. It's not what your neighbor's house sold for last week. And it's absolutely not what your neighbor's home sold for in 2021. We need to be making sure that we're having conversations about how to price your home strategically and look at the competition that is actively on the market, because this is night and day difference. These are homes pricing it right at 28 days. These are homes that are pricing it wrong at 51. These outliers are astronomical. Here's what's also interesting. These price decreases, 52%, right? We looked at it, and nationally, we're sitting at 38%. Historically speaking, we know that 1/3 of all homes take a price cut every year. Nationally, sitting at 38. Arvada is sitting at 52%. That's what weirds me out about this number right here, right? When we just saw an $85,000 increase on list price, and yet we're seeing more than half of all homes in Arvada are taking a price cut. So also worth the conversation. So what I'm probably doing if I'm going on listing presentations, I'm pulling this out. I'm saying, hey, Mr. and Mrs. Seller, if we don't price your home right, chances are we're taking a price cut after we sat on the market for almost 2 months. Guys, this is why data, we need to be absolutely sure that we have this and be able to present it. Numbers don't lie, right? We actually absolutely tell a story with this to show why we are the real estate economists of choice for our people. Then we're going down, we're looking at price increases. Number doesn't excite me. It has come down a little bit. And again, these are just new builds. These are like phase 2, stage 3, right? These are just new builds that are coming to the market, and they're in different phases, and they're raising the prices, right? They're like, okay, we're in our next phase. Now we're raising all the prices $10,000, right? That's what this is. So again, we know that this isn't a huge number because they're slowing down production. And keep in mind this isn't back in 2008 either. Back in the day, right? A little bit ago, when we were talking about new builds, we could have been talking about spec homes, right? Where people are actually building houses and then like, come look at this house and place a bid. They're not doing that anymore. Pretty much the only spec home you have is the new build that is the model home, where the people are actually sitting inside of it, the sales reps, and selling the houses, and they offload it later, maybe at a discount, maybe not, depending on where it is. But as we're looking at this, we also don't have a lot of spec homes being built. So 3% homes, these homes are pretty much sold. Like they go through, they sell a home, and then they build it. They go through, they sell a home, then they build it. Again, which is why we're seeing this isn't a super exciting number. This is not going to make any big swings anyway to help our system. Relisted 6% also makes sense. We're going to see this number kind of skyrocket a little bit more, especially as things are happening. This is probably why we're also seeing 52% is, and I say skyrocket, just go up. I doubt we see double digits. And as we're going through, we have discerning buyers. They're going through. We're talking about a 600, in this case, we're talking a $785,000 home in Arvada, Colorado right now. And they're looking through this home, and they're finding things that are wrong with it, and they're backing out of these contracts because the buyer and the seller cannot come to terms. So 6% of all homes are falling out of contract and being relisted. So we just need to be cognizant of that number. Inventory, there's a 248. Median rent price is $3,000. It has swung up a little bit. And again, we could see some things happening as they're building less apartments. And as there's less affordable, I also saw an article, which I didn't feel was worthy of this conversation until I had a little bit more information about it. But I also saw evictions are going back up. I can't remember the percentage, but nationwide evictions are starting to go back up across the United States. And it's because a lot of the protections that were put in place are coming to an end. And we're seeing more and more people be removed from their residence because of not paying. And the article that I was reading, this is why I didn't jump into it too much, was going through and was really pointing out it was a lot of software mistakes, which I thought was really interesting. is they were actually saying that a lot of these landlords or property management companies actually have automated software that's actually running different things and models. And it was getting to the point where certain aspects were happening and it was actually sending off default letters. So that's why I didn't bring it up, because I think there's too many moving pieces for us to have a conversation around it. But again, $3,000 a month versus 4,000 for ownership is pretty much where our numbers are going to look like right now. You can either rent for 3,000 or you can own for 4,000, and that's pretty much the conversation that these people are having right now. What makes the most sense for them and their lifestyle and for what they're looking for the rest of their lives to kind of look like.